Okay, and welcome back, students who are taking financial accounting. In this series of videos, we are working on the assigned homework problems for Chapter 5. We're working on the problems from Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so let me jump down to problem 5-53. Get my pen. All right, so it says here, link supply, inventory errors. Okay. Now, you will have errors in inventory, okay? I mean, if you're using specific ID, an error is, really doesn't, I mean, you shouldn't have errors. There's double checking that goes on with a specific ID to make sure that you've, got the right ones. If you're, something is damaged, you're writing it off. So with specific ID, you shouldn't have that many errors, but using other methods, it is possible to have errors. And if you do, and you don't realize it, you have reporting problems. So that's what we're looking at here, is what happens when you have inventory errors. So they're saying, okay, here's my data on the financial statement. This, of course, is the income statement for 2012, 13, and 14. It says here, prior to issuing the 2014 statements, auditors, right? Remember, the auditors are people who are coming in and looking at your books to see, find any mistakes that you've made, or they're not sure about the way you're reporting things. They found that the ending inventory for 2012 was understated by 5,000. And the ending inventory for 2014 was overstated by 8,000. The ending inventory for 2013 was correct. So for 2012, this is understated. For 2014, it's overstated. And for 2013, it's correct. So understated by 5,000, overstated by 8,000, and this is correct. Right. So it says we want to know, state whether each year's income statement and each year's net income before corrections is understated or overstated, and indicate the amount of the understatement or overstatement. Okay, well, we just did that. The data told us that 2012 was understated by 5,000, 2014 is overstated by 8, and 2013 was correct. That was part of this data. Okay. Now it says prepare corrected income statements for the 3 years. Okay, I'm not going to rework, create new financial statements. I'll use the data here and just, correct the numbers that are necessary. Okay. So if our inventory is understated by 5,000, okay, we're looking at our ending inventory here of is 19, right? So if it's understated by 5,000, that means it should have been 24,000. Okay, and if it's 24,000, all right, that means this is now 114, which means that this is 65. My gross profit is 65. My operating expenses stay the same, and my net income now becomes 22,000. Okay. Remember, with my inventory being understated, my net income goes up. Right. Now, since since my inventory is 24,000 here, okay, that means I end up adjusting my beginning inventory for 2013, right? Ending inventory for 2012, becomes the beginning inventory for 2013. Right? Now they're saying that the ending inventory for 2013 is correct, so I don't have to make an adjustment there. However, my cost of goods available for sale is now 136, which then my ending inventory being correct causes my cost of goods sold to be 120,000, right? Which then changes my gross profit to 57, right? And my operating expenses stay the same, so now my profit ends up only being 16,000. Okay, so notice what happened here. Okay, in 2012, because our inventory was understated, that means we had $5,000 additional in net income, right, when we corrected it. But when we corrected it, that means in 2013, because our ending inventory is correct, we end up with $5,000 less in profit. So that that understatement in 2012 cost us in 2013. All right, but when we're looking at 2013, our ending inventory is correct here. All right, so it's, we're going to start out with the proper beginning inventory. Now, in 2014, if our inventory is overstated, okay, so we don't have 23,000, it's overstated, so we only have 15,000 in inventory, which then goes and changes all of the numbers again. So this is 146. My gross profit becomes 52, and my net income becomes 10 because I'm overstated in my inventory. Right? So those would be all of the changes that I would make on, and I would reproduce the new financial statements using the new numbers. All right, I'm not going to go through that because that's just going to take a lot of time. I mean, if you did it, this problem is supposed to take 20 to 25 minutes. Yeah, it would take that long, but I don't think I need to do that since I could just work through the numbers here. The big thing here to be thinking about is what are the effects of being understated or overstated and correct in our inventory. And remember, your ending inventory becomes your beginning inventory. Okay, so when you affect one year, you're affecting the next year. Okay, and in this case here, because our ending inventory for 2013 was correct, okay, then what happens in 2012 doesn't affect 2014 because the ending inventory was correct. It says here, what is the impact on the 2014 income statement if the 2012 inventory error is left uncorrected? Okay. Again, there is no impact. All right, I just said that because 2013, our ending inventory, was correct. The mistake in 2012 only affects 2012 and 2013. Right? The ending inventory in 2013 being correct, let's assume that 2014 was right. There was no overage or underage, right? Then our we'd be treating 2014 as if there was no error whatsoever, and we would have had the $18,000 in profit. The only reason why we're adjusting 2014 is because our inventory was over in 2014. But the point being here is that what happens in 2012 affects 2013, but it doesn't affect what happens in 2014. One year affects the next, but it doesn't affect the following year, right? Now, if there was a problem with 2013's ending inventory, yes, then that would affect 2014. So, without going into it too much further, okay, just realize that if you have a mistake in one year, it will affect the next year, but it doesn't affect the following year, okay? But notice that you do have to pay attention to, like in this case here, if somebody keeps on making these kinds of mistakes, I'm going to have to have a good talk with one of my managers as to why I'm having mistakes in my inventory count, okay? Because you're doing a physical inventory and it should be correct. you don't want to be having these mistakes year after year after year. Realize that in a small business, these kinds of errors shouldn't happen. In a huge business, where you have, your Microsoft or, Dell computer, where you have computers all over the place, it's hard to keep track of inventory. And so in the very large businesses, yeah, you do have this issue, and inventory just generally doesn't necessarily be correct from year to year to year. And that's why you have auditors looking at your books and, making sure that things, are in place, because a second, an unbiased set of eyes has a tendency to be able to spot things that you who are involved in the business can't necessarily see. Okay, so with that, I'm going to stop here and go on to the next problem in the next video.